Today we're going to introduce the definition and the topic of finance and the concept of financial management. As we go through the course, we will learn, or we will see, that finance is a very math-heavy subject. There's going to be a lot of calculations that you're going to learn and how they're applied to a financial setting and when and what they're used for. But before we move forward, let's get our feet wet with introducing ourselves to finance. Finance is usually or oftentimes confused with accounting. In fact, in large organizations, the finance department really consists of accountants or people performing accounting responsibilities and functions, such as putting together profit and loss statements, balance sheets, or other financial statements, putting together management reports, and putting together and creating operating budgets. Finance or the art of finance does not really cover any of those topics. While they utilize some of those topics, finance can really be defined as the art and science of managing wealth. It is about making decisions regarding what assets to buy and sell and when to buy and sell these assets. Now, when we refer to assets, they include stocks and bonds. They include other invested assets, if we're talking about personal finance, such as collectibles and art, personal residences. But from a corporate perspective, assets also include machinery, buildings, and raw land. Most of the time, especially in large businesses, the decisions of when to buy, when to sell, and what to do with these assets are made with the help of financial analysis. Because the main objective of finance is to make individuals and their businesses better off. Put another way, finance involves all of the processes of adding value to the firm. Financial management is defined as those activities that create or preserve the economic value of these assets to the individual, the small business, or the corporation. In a nutshell, financial management comes down to making sound financial and investment decisions. There are four main interconnected and interrelated areas of finance. The first is corporate finance. Second is investments. Third is the financial institutions and markets. And fourth is international finance. If we were to ask any general student before taking this course, they would relate finance more closely to the areas listed in number 2 and point number 3. Investments in financial institutions and markets. This is when the firm puts, or individuals put their money into stocks and bonds, and the market and institutions that help bring the buyers and sellers together for these stocks and bonds. But number 1 is very important. Number 1 involves managing the cash flows and the capital budget decisions of a firm. Capital budgeting relates to the projects that are going to be undertaken that would add value to the company. And fourth is an area that's becoming more and more important as more and more businesses become multinational businesses, and that is of international finance. Not only buying and selling of stocks and bonds in international companies, but financing international projects and expansion. If you look at any basic organizational chart for a company, and for this instance, it usually relates to a large company where you have the CEO or Chief Executive Officer as the main officer in charge of everyone else. Under them, you'll have various what's known as functional heads. such as a marketing manager, manufacturing manager, the IT manager, the HR manager, and you have the finance manager. The finance manager is also known as the chief financial officer, and they're responsible for all of the financial functions of the business. They oversee the treasury functions, which are the cash flows in and out of the business. They oversee investor relations, the communication between the firm and its investors or owners, and the controller of the organization, who is normally the chief accounting officer and who is responsible for any back-looking financial statements that will tell the investors how the company is doing, and for filing the taxes of the organization. The finance manager has to be familiar with all of these tasks in order to provide general guidance to the CEO. But the finance manager's main decision or main role is to make sound financial decisions utilizing the concepts and techniques we're going to be learning throughout the course. In order for the finance manager to make sound financial decisions, they need to look at one particular item that is most important, especially in a public company, and that is to maximize the current stock price. You'll also hear this referred to as maximizing shareholder value. Now, when looking at maximizing the stock price, the finance manager usually has to make a decision on short-term profit maximization versus long-term stock price maximization. And they have to understand why they're not the same, and they have to know which one is more important. In the short term, investing in a capital project that will add long-term value to the company will usually incur some short-term charges. These short-term charges will increase the expenses of the organization and lower their current profits. These current profits may lead to a short-term drop in a company's stock price. But in the long term, this project will add value to the company and its stock price will increase in the long run. Now, these two are not the same because they have different looking objectives. Profit maximization is short term, stock price maximization is long term. As we mentioned earlier, financial management involves three main functions. The first being capital budgeting, which is setting aside funds for capital expenditures or capital investment. An example of a capital investment would be building a new plant or buying a new piece of land to develop. The financial manager also looks at the capital structure of the company, how much debt the company has outstanding, how much equity it has outstanding, what's the debt equity ratio, how much is the debt burden or debt service costing the company on an annual basis, and will any of this or any combination of these structures add value in the long term. The third function of financial management is working capital management, and that is normally referred to as your treasury functions. Working capital management ensures that the company has enough money coming in to pay its bills. So it's money coming in, or your accounts receivable, versus money going out, or your accounts payable. The finance manager has to determine the best way to manage the incoming funds and the outflowing funds. And part of this responsibility is based around determining the best repayment structure for any borrowed funds. When we get into the second part of time value of money, we will learn, or we will go over some examples of repayment structures and how the different type of structure, how often or the frequency when a loan is scheduled to be repaid will affect cash inflow or the cash outflow of an organization. The finance manager has to make sure that the debt obligations are met on time, which basically means that make sure the bills are paid on time. And as we said earlier, again, to make sure that there's sufficient funds available for carrying out daily operations, meaning that the cash coming in has to be greater than the cash going out. A finance manager, since they deal with adding value to the firm, are responsible for interacting with various internal and external stakeholders. The internal stakeholders include all the departmental managers and other employees that they deal with, such as employees in the Treasury Department or the Treasury Manager, the Controller and his or her staff, the HR Manager, the Marketing Manager for the release of funds for marketing investment or the release of funds or projections for bringing on additional staff. The external parties include customers, suppliers, government agencies, and most commonly and importantly, creditors of the company or who the company owes money to. So, we spent some time introducing students to finance and the finance manager, but why should students study finance? Well, besides trying to pursue a career in finance, there are numerous benefits to students to have an understanding of the financial functions. First is to understand how and why financial decisions are made in large and small companies. The better you understand the decision-making process, the better decisions you can make. The better decisions you can make, the more value can be added to the firm, large or small. Studying finance helps individuals increase their own compensations. Finance is a lucrative field for those who study and move forward in it, but for those who don't and are in other areas of business, understanding on how to analyze potential deals and fully understanding the value-added structure can help them become more successful and thus have bigger increases in their compensation than employees that do not understand these concepts. Students that study finance can improve their contributions to the success of the companies and the people that they work for, similar to what we just described above. Having a thorough understanding of how specific projects or deals can add value to the company could help the success of the company and the people they work for, which can have a trickle-down effect in their own compensation. And finally, understanding finance can help students understand the trade-offs that they face in making personal financial choices and help them select the most appropriate action. When we move forward and we talk about loans and loan repayments, you will learn and understand the basics on how mortgages are calculated, how car loans are calculated, and when you're eventually going to purchase a house or a car, you can have a better understanding of those processes, and you can make decisions that are the best in your best interest, as opposed to the best interest of the vendor that you're buying them from. This concludes our introduction to finance and the financial manager. As you can see, finance is very different from accounting. The main difference I could stress is that finance is forward-looking for an organization, i.e., looking at what projects will add future value to the firm, while accounting is backward-looking, i.e., telling a story in numbers through the financial statements on how the company has performed in the past or up to a certain period of time. While the accounting functions usually roll up into a finance department, accounting is not finance. Far from it. Finance is a much different science, and as we go through the chapters and learn the different topics of finance, this will become clearer to you.